Right, on to agriculture. Very interesting standard. I think really the simplest way to look at this and just get it, because it's not that it's complicated. It's actually very straight. Is that typically when we think of inventory, yes, we buy inventory. For example, it doesn't really matter what the inventory is. It could be vegetables or um, really doesn't really matter. Any inventory we've talked about, IAS2 has always looked at inventory as you're buying the thing, and the problem here is the potential that this inventory over time will fall in value. That's the issue, isn't it? Before you sell it. And it will be with you for a period of time before you sell it. You don't want it to be with you for too long, and so there's the risk of obsolescence. But with agriculture, think of a cow that will give birth to sheep, and then you'll have give birth to sheep. A cow would give birth to calves, and these calves, if you like, when they're born, they as over time they're growing and they're actually increasing in value. You see where I'm going? So the question is, well, how do we recognize this inventory? Because that's the point. You're holding it for a period of time, but we have a completely different process. So these calves, these calves in particular are referred to, or pigs, or these animals that are born and are growing, and even the parents as they're getting older, are referred to as biological assets. This is, or even plants. So you can have, if you like, the vines or the grapes on the tree. So over time, the grapes, yes, over the years are increasing in value until harvest. So all of these fall into this bracket of being called biological assets. So some examples here, I've just picked a few. Sheep and their children, and cattle and their children, pigs and their children. So cotton plant and rubber trees. So the substance coming out, if you like, before they're harvested, if you like, is referred to as biological assets. And IAS41 really applies to this. And I sort of mentioned earlier on is that up till the point of as they're developing, they are increasing in value. So whilst they're on the tree, if you like, you would argue that, of course, same thing with the milk in the animals, until they're actually harvested. Same thing as the latex, until it's harvested, all of it is regarded as IAS41 until the point of harvest, because as soon as things are harvested, the truth is they start to spoil, or to, so to speak. But when I say harvest, I'm not talking about babies of animals. You can see there's not here. Those are just IAS41 anyway, right? This is just about these type of leaves and fruit, and if you like, grapes would come in here as well. So this is all IAS41. But as soon as it's harvested, of course, and as well processed, well, it's IAS2, if you like. Even cheese, I mean, I was talking about cheese the other day, that sometimes cheese takes 15 months to mature. And in that period, it is still inventory, if you like, and you're just holding it as IAS2. Okay, great. So what is a biological asset? A living animal or plant, and it should be recognized if it is probable that economic benefit will flow, just like we typically recognize assets, and that the cost or the fair value of the asset can be measured reliably. And typically this is the case. Most farmers are very aware of what the price of this, because these are things that are being, if you like, dealt with around the world, and in many countries people are constantly buying and selling animals for food, so we do have a good understanding of what we believe the fair price or the fair value of the asset will be. Of course, the core definitions of an asset, in that the entity controls the asset, are critical. They have to remain, and again, it is probable that economic benefit will flow. So, so for fairness, or to prevent any sort of issues, what they're literally saying here is that if you have a sheep, for example, if you have calves worth £1,000 in January, and by March, the market value, people willing to pay 1,500, what you do straight away is recognize, debit 500 in addition to the sheep. So your sheep was originally recognized at 1,000. Recognize the 500 and straight away credit your P&L with 500. So recognize profits immediately, right? But unlike inventory, we hold. If we bought inventory at 1,000, we wait until we sell it. You've not sold the sheep yet. So in June, it might be 1,800. Recognize another 300. Credit P&L with 300. So just keep adding on the increase in the fair value of that asset as we're going along. The argument is that if there is no fair value, then the cost model should be used, right? That's sort of the argument. Subsequent measurement. So yes, again, like I said earlier, when we measure to fair value, of course, what you're supposed to do as well is always subtract any sort of transaction costs, so to speak, points of sale costs, any auctioneer costs, taking any gain straight to the P&L, like I've said. And that's kind of the thing. You'll see, I'll show you a question in the end, but that's the main point. That's it, really. Think of it as a revaluation, but this time revaluation, not like IAS16 that doesn't let you put the profits in P&L, but no, here you are, straight away put the P&L in your income statement, straight away. This is the, again, this is a slightly different one. So this is the actual bearer plants themselves. Now, I like to think of them, I think vine trees are a good example. And I was at a wedding once in the north of Italy, in Gubbio, a couple of years ago, about 2-3 years ago. Actually, yeah, 3 years ago, so that 2017, I think it was. And I was driving up in the north, and I just saw these fields of vine trees, and those trees typically will grow and will continue to develop for at least 20 years, if not 25 years, at least, I'm told. And as you can imagine, this, because of the length of these here, what we're seeing here is we're really looking at almost, you have to call them, if you like, non-current assets. They're there for a long period of time. So the trees themselves are recognized under IAS 16, but the grapes on the trees are recognized under IAS 41. So of course, the first year the grape is still developing, and it keeps developing over time. So the grapes themselves are developed under IAS 41, but the trees themselves are talked about or recognized under IAS 16 and revalued that way. So a bearer plant is a living plant that is used in the production or supply of agricultural produce, and it's expected to bear fruit for more than one period, of course. You can see this, again, like I say, it's around for over 20 years, and has a remote likelihood of being sold as agricultural produce. So it's rare we're going to be selling these vine trees, if you like, cutting them down to sell them, until, of course, they are, their lives have come to an end, which is rare. I'm interested to sort of understand what happens to that. I mean, it's a tree, isn't it? Be there forever. So therefore, items such as vines and tea bushes and fruit trees may be classed as bearer plants and treated as PPE rather than being accounted for under IAS 41. And so we literally, yes, in terms of agricultural produce, yeah, again, like I said here, fair value less cost to sell. After produce has been harvested, IAS 41 ceases and the produce becomes inventory. So we recognize it under IAS 2, as you would, right? You want to get rid of that fruit, you want to get rid of those grapes, you don't want them going bad because they're no longer receiving life as you like from the trees themselves. Yeah, and so production quotas and things like that are recognized under IAS 38. Land is not a biological asset. It's a tangible, non-current asset. It's just not ever devalued. It's only ever revalued, according to our syllabus, at least upwards. So we don't depreciate land, and that's under IAS 16. This 16. So this is an example here to kind of just explain what's happening here. So really what I'm saying is we are literally just adding on those values. We have a herd of 4-year-old pigs held on the 1st of Jan. So 1st of Jan, and so here we are. This is what the fair value of 4-year-old pigs look like on the 1st of Jan. That's £200. So 200 times there's 5 of them, yes, and that's £1,000. That's £1,000. 5 of them. Then it says here, I mean, these 5 pigs, by July, they're now worth 212. So literally, I'm just going to add on. That's the value of these 5 pigs by July. But then it says I buy another pig on the 1st of July for 212. So that 4th pig, or that 6th pig joins them. And now that's the value in my ledger, 1060 plus 212, if you like. So I have 1060 plus 212. And I have 1260 72. And then it says that these pigs now are 5 years old and they're now worth 230. So literally, I now have another increase of 18, isn't it? So I now add on another 18, but this time times 6 pigs because that's what I'm working with now. So I'm just basically always topping up with the addition. By the way, they've taken off all the point of sale. It says less, so they've taken off the point of sale costs. So I have 18 times 6, which is 108. So I add on another 108 to this. And so I now have there 81380. And this becomes the value of my pigs by the end of the period. Yeah, and that's how we deal with that. So that's IAS41. Pretty straight. You should probably you'll see a few of those, I imagine, in section A and in section B. But your reaction is always to find the fair value and just debit the asset and then credit profit and loss account straight away. Awesome. See you. Yeah, that's the end of this chapter. See you in chapter 9.